Good evening, everyone. Thank you for taking the time to come and hear our views for 2021. This is our last English webinar of 2020. One of the positive consequences of Corona is our ability to interact with clients via Zoom. We've had a lot of positive feedback. Tomorrow at the same time will be a webinar led by my colleague Shmuel Ben-Ari, who will be focusing more on the Israeli market. It's a webinar in Hebrew, so those of you who want to understand Hebrew and want a little bit more insight into the Israeli economy can join at the same time tomorrow and hear Shmuel. You might also hear some slight differences between his views and my views as we've tried to thrash them out. But we thank you for taking the time and coming to hear what we have to say. I hope you are all safe and well, and I see on this call their names I recognize from South Africa, from Mexico, from the UK, from all over Israel. I hope that you're all safe. Within Israel, we're feeling the optimism of the vaccine. The vaccine has started a rollout, and you can feel, for those of you in parts of the world that you don't yet have the vaccine, we feel the optimism. We see that there's light at the end of the tunnel, and it's really amazing. But on the other hand, the virus is still out of control, so precautions are needed. Okay, let's dive right in to my presentation. I'm going to be speaking for about 25 minutes, maybe 30 minutes, and then we'll be taking some questions on whatever you have in mind. Okay, so let's just have a quick look back at 2020. Discipline paid off. Asset allocation did its job. If you were invested in a reasonable portfolio in January, closed your eyes and looked at your portfolio at the end of the year without doing anything, then you would have done absolutely fine. If you would have panicked in March and de-risked at the wrong time, then you would have missed out on the rebound. Buying anything in April resulted in exceptional returns. At Pioneer, we did a few things. We bought, leading into the crisis, we sold a few things which we thought were too risky, and then we started buying. In April, we bought NASDAQ, where we made about 40% on that line item. We bought investment grade bonds. We made about 12% on that line item. In May, we bought Chinese internet stocks, which we've made about 30% on that line item. So just those few tactical decisions added about 2% to client portfolios. So we did really well with our tactical positioning, but you didn't have to be tactical this year. All you had to do was just be disciplined and stay invested throughout the crisis and have some faith in the markets. Obviously, if you were in technology, then you were a clear winner for 2020. Technology did exceptionally well. They were the Corona winners, especially the big name tech stocks. The consequences of massive amounts of monetary policy will be with us for decades to come. The main consequence, in my opinion, is low interest rates. I think that for the balance of my professional career, we'll be dealing with low interest rates. When people talk about interest rates going up, short-term interest rates in dollars are close to zero. So if interest rates go up to 1%, it's certainly nowhere near normal, or what we regarded for the last 50 years as normal in the interest rate environment. The other consequence at a certain point in time will be higher taxes, probably all over the world. So more and more financial repression are the consequences of Corona, and they're going to be with us for a very long time. So that's a brief view at 2020. Now we're going to flip over into 2021, and I'm going to challenge you with 6 poll questions just to create a little bit of interaction. And I want you to think and put your minds into what it means to predict 2021. We as a team have put our heads together and we've tried to identify the key issues and the key risks of 2021. Now I'm going to challenge you to do the same. So we're going to have a little poll. I'm going to launch the poll now. So those of you who can see the questions, if you could just give us your thoughts, I'll read them out. Most of the people on this call have some connection with Israel, so the USD shekel rate is very important to them. What do you think the USD shekel rate will be at the end of 2021? Do you think it will continue to strengthen? So in the region of 3, 3.2, will it be 3.4, minor recovery, or a full bounce back of 3.7? Please let us know your thoughts. Then the next question is sustainability and impact investing. Sorry, I'm just getting some technical guidance here. Say again, please.
They need to press on the poll icon in order to.
For those of you who can't see the poll questions, at the bottom of your Zoom, there's a poll button. You push that, and your poll question should pop up, and then you can start participating in this theme. Another theme, the next one is sustainability, impact investing, ethical investing. Do you believe it's a fad or a fundamental change? Do you think COVID will disappear by the end of 2021? Fundamental to predicting 2021. What will be the virus? What will be does the vaccine work? Will there be mutations, etc., etc.? Will you take the vaccine? Interesting one. I expect most will do it. Let's see. By the end of 2021, do you think that the stock market will be more than 10% where it is today, between 0 and 10, a small loss or a big loss, at least 10%? Will Biden succeed in increased taxes? This question is linked to who will control the Senate and the Georgia election in January. If it's a split Senate, then arguably the casting ballot falls in the vice president's hands, and arguably they will get tax increases through. Who knows? Let's just give it a few more minutes or a few more seconds, please, to answer. Just remember, if you can't see the poll questions, you push the poll button at the bottom, and I welcome your participation in this forward-looking crystal ball game. Okay, let's just do another 30 seconds or so. You can just, and we've got 61% of the participation to vote. Let's just wait for 70, and then we will end the poll. Okay, so anyone need more time? Give you another 10 seconds. Till 70, I want 70% voted, and then I'll end it. All right, we've got 70% participation of the attendees. I think we'll end it here and share the results. Okay, so what will be the USD NIS rate according to everyone here? More or less where we are today. 45% think that we're about 33.2%. ESG and impact investing, 1/3, 28% think that it's a fad and some sort of joke. Others think 73% think it's a fundamental change. Will COVID disappear? 30% say yes, 70% say no. This certainly affects the amount of risk that you can take. Will you take the vaccine? Overwhelming 95%. I'm very supportive of the 95%. The 5% that don't want to take the vaccine, we should talk. And then, oh, by the way, I should have said in this thing, don't worry, it's anonymous. And we won't fire you if you get them wrong. So I should have said that in the beginning. Then, okay, the S&P moderately up. So if we take the two sort of positive scenarios, we've got 80% of the voters thinking that the stock market's going to go up in 2021, which is encouraging, and I kind of agree with that view. Will Biden succeed in increased taxes? 75%. Well, it remains to be seen what type of taxes will he increase, personal taxes or corporate taxes. I'm inclined to believe he'll increase personal taxes more than corporate taxes. But anyway, let's dive into my presentation now. Okay, the key issues that we identified for 2021, obviously the dollar. This affects a lot of our clients, particularly the immigrant population in Israel who've left capital abroad denominated in dollars, and they're facing a very strong shekel. We've got South African clients who are watching the rand, and they have a different view. They like to see a weaker dollar and a stronger rand. And we'll have a discussion about where we think the USD is going. Bubble in stocks, e.g. Tesla, conversation point. A lot of people think the stock market is very high. We'll talk about that. Inflation. Will inflation, as a consequence of the massive amounts of monetary policy expansion, happen? And if it happens, how big will it happen? And how do we defend our portfolios against that? We're going to talk about that. Impact investing, and what does it mean about, firstly, what is it? A lot of people don't understand it, so I'll give a few words about that. Post-corona recovery outlook, how long till all sectors normalize? Can we identify a sector that is attractive or looks like it will rebound faster than the others? Obviously, this is linked to the path of the virus itself. If the virus continues in one shape or form, or if the vaccine doesn't work, et cetera, then those sectors which are lagging and arguably cheap, perhaps are not as attractive as they may seem. Brexit hangs in the air, continues to annoy all of us. And then low bond yields. So this is a big deal that requires some planning and some expectation management in portfolio management. Okay, so let's just look at some of the bull and bear arguments about the US dollar. These are just some of the the big picture stuff. One of the questions we got in the registration was, is the dollar still the reserve currency of the world? Absolutely. In my opinion, it is, and there's currently no second place. The next obvious currency is the euro, but the eurozone has got some fundamental strategic weaknesses. It's only been 10 years since the 2011 European crisis, and the problems that led to that crisis in 2011 have not been solved. The European Union, with Britain leaving and Holland wanting to leave, and you have monetary union with fiscal independence, it really has some major problems. I don't think the euro is a reserve currency. The next obvious is Chinese currency, the yuan. We still need it needs a lot of time. Certainly size-wise, it's becoming a candidate for the reserve currency of the world, but the Western world doesn't trust it fully, and it's not a free country like the rest of the Western world, arguable. But we still don't think China is in line to be a reserve currency. The US is the structural safe haven currency. One of the correlations that you can rely on in finance is when there's a risk-off scenario and when the markets are crashing, the dollar goes up. So that means that people still think that the US dollar is the structural safe haven currency, and I don't see that disappearing. In 2021, if we have any sort of risk-off scenario, the US dollar will strengthen pretty quickly. Most international business is conducted in dollars. Most commodities traded internationally are denominated in dollars and priced in dollars. So the US dollar is a long way ahead of any other currency. Superior growth prospects in the USA. No one can argue that the USA is fundamentally strong economy, and therefore it will attract capital, and that will support the dollar and limit the downside of the dollar. So I don't think that, people talk about a collapsing US dollar. I don't see a collapsing US dollar. The dollar is under pressure for reasons which we'll talk about, but I don't see it really collapsing. There's a minor interest rate advantage for those who believe that interest rates are going to be the main drivers of currency moves. US interest rates are moderately positive, European interest rates are negative, therefore money will flow to the dollar, giving it some support, but it's not a major advantage. Looking at some of the bear market arguments about the dollar, the more the world recovers, right, the less attractive the US looks, and the more money will go elsewhere, and therefore the promotion of investments outside of the United States is arguably a bear market signal for the dollar. Rates are likely to remain low, and therefore there's no major rate advantage. Getting back to what I just said, just a year and a half ago, there was a 2.5% rate differential between the United States and Europe. So if you took your euros out, invested it in dollars, you got a 2.5% premium over what you got in Europe. This was a big push. Now the interest rate advantage has practically disappeared. It's there, but it's very small. US real rates are negative. So you take your nominal rate minus inflation, you have a negative real rate. real rates are a driver of currency strength. And inflation, even if it increases and rates stay low, that's another signal that the US dollar will weaken. Worsening trade balance. The government balance sheet of the United States looks terrible, okay? And they're going to increase their budget spending with more deficit spending, and that's going to further weaken the fundamentals of the dollar. Inflation fears. I believe in inflation differential is a big driver of currencies over the long term. If one country has high inflation and another country has low inflation, then over time, the purchasing power of the high inflation country is going to be eroded versus the low inflation country. I'm a big believer in this. Now, in the US and Israel context, dollar inflation is actually higher than shekel inflation. We'll talk about that in a second. USA growth prospects. So as I said, the United States is attracting capital, which will make the dollar stronger. But if the tech giants, which dominate the world, Apple, Facebook, Google, etc., are placed under antitrust pressure, they try to break up those things, those companies, then those prospects are less attractive and less supportive of the dollar. Now, I know there's some people on this call from Mexico and whatever with less of a interest in Israeli shekel, but most of the listeners here are very interested in the shekel. So let's just talk about the Israeli shekel for a second. The most powerful reason why the shekel is strong is because of gas exports. In 2020, two major gas fields in the Mediterranean, Leviathan, which is the biggest by far, and Tamar, which was operational before 2020, we exported to Egypt alone 3 trillion cubic feet, okay? So that is worth about $9 billion, which for Israel is a lot, okay? And that is $9 billion, what they call at the well. It's before you factor in the transport costs and the piping costs. So, and who owns the pipes from Leviathan through Israel to Egypt? So it's even more than that. So that's the minimum number of gas exports in 2020, and more gas exports are planned. They're going to sell gas to Turkey, they're going to sell gas to Jordan, and this is a risk of what's called the Dutch disease, which is where a good news issue like a natural resource becomes so significant in the economy that it hurts other aspects of the economy through a stronger and stronger exchange rate. So it looks like there's some strong signs that the shekel will continue to get stronger. I mentioned the inflation point. Inflation in Israel is extremely low. It was even negative for one quarter. It's basically zero. High-tech innovation will always attract capital. So if Israel as a startup nation is successful, and every now and again we have these huge companies, huge exits or IPOs, that is essentially exporting of intellectual property, money coming in, supporting the shekel and weakening the dollar on that cross rate. Weaknesses in Israel, political instability. Last night they announced that the government's going to collapse, and we're having our fourth election in 2 years, and the shekel strengthened this morning. So I'm not a big believer in the political argument. Israel's been through wars and the shekel is strengthened. So there's some dynamic there. It's not a strong point, but the next one I got here is high tech needs a weak shekel. The stronger the shekel, the harder it is to sustain research and development in Israel because the salaries are higher and less competitive. We've had corona implications. We've got huge unemployment, we've got increased debt, we've got certain sectors which have been decimated, tourism, etc. And this has weakened the Israeli economy and should weaken the shekel more than it has. Low interest rates will not attract capital. Our interest rates are low in shekel and we expect them to stay low in shekel, and they will not attract capital. And therefore, in theory, the shekel should be weaker. So which of these two arguments are going to win over time? Let's have a look at the technical analysis, which is a graph. And the green line here is the dollar shekel from 2005 to 2020. And the blue line is the euro shekel. The first thing you see with all these squiggles is the volatility. And what normally happens with a currency is it moves in one direction and it overshoots where you think it's going to be, and then it pulls back. And we've seen this with many currencies around the world, but then there's a long-term trend. Okay, for the South African listeners, we've seen huge volatility in the rand, but an undeniable trend. You can't fight the trend. And I think the same is true here. So we have, look at the green line, which is the shekel. I don't know if you can see my mouse. I hope you can. We see a strengthening and then a sudden weakening, strengthening, weakening, strengthening, weakening, a little bbit of a longer strengthening. I think that if this continues, it's reasonable to expect some short-term weakening. You know, we've overshot 3.2 or 3.22 shekels to the dollar is an extremely low rate by historical purposes. We've been here before, or near here before, but it's a very low rate. So I think in the short term we might see 3.3, 3.4. I don't think we're going to see 3.7 or 3.8, but I do feel that this trend, okay, which has been reinforced by gas exports, I think this trend might continue. So in 2021, we might see a rebound back to 3.3, 3.4. But if you think 2025 and beyond, we might have to get used to a range of rates even lower than we do today. What does this mean for investors? They need to look at how much shekels they have in their portfolio and plan accordingly. Okay, so that's the currency story. Impact investing, which is a broad term which covers environmental, social, governance, responsible investing. In a post-corona world and a Biden-led world, climate change, zero carbon targeting is back on the political agenda. Countries have these long-term zero carbon footprint targets, 2050, 2060, very long-term. I don't know how meaningful it is, but at least Biden has put this back on the agenda, and it is real, and it is fundamentally changing everything, in my opinion. We at Pioneer are getting it more and more. Clients are asking us to adapt a strategy of ethical investing. Whereas 5 years ago, we never heard it even once. It's becoming more and more. Clients want their money invested in an ethical way. If we can come up with a strategy that is ethical, that doesn't compromise either the risk or the return metrics, then we would have succeeded. Currently at Pioneer, we're maintaining our traditional asset allocation, traditional portfolio construction, and in parallel, we're running ESG or environmentally sensitive strategies for those clients who want it. What I suspect will happen over time is that they will merge. We will take more and more environmentally friendly products or ESG products and put them in our traditional. But right now, the jury's out. We're still, and it's the braver clients who are asking for the ESG solutions. Just to summarize in the highest possible terms, what does it mean? So you have exclusion screens and inclusion screens. So if you take the MSCI World Index, 2,500, 3,000 of the world's largest companies, and you remove the naughty companies, for lack of a better word, weapon manufacturers, nuclear companies, fossil fuel, tobacco, UN designated bad boys, whatever, you remove that, you have a MSCI that is sort of cleansed or screened, ESG screened MSCI index. So that's exclusion way. The other way is inclusion, which you take companies which are focused on climate change, focused on sustainable strategies, sustainable businesses, electronic cars, etc., and you include them in the index-based methodology. Just this week, Tesla became part of the S&P. Tesla is I'm going to talk about it in a bit more detail, but just in the context of ESG, it's very interesting because it's electric cars, but it scores very poorly on governance. It relies heavily on one guy, and so it scores very poorly on governance, but very strong on environmental. That's just one example of the gray area that results from impact investing. From my point of view, what I see is a huge, huge, huge trend of ESG investing. All the major firms around the world have have invested enormously in ESG departments. A lot of traditional bond funds, equity funds are, they want to be included in an ESG world. So they are dropping companies like Chevron and Exxon and petrol companies, and they're for ESG reasons, and then they get the ESG stamp on their fund. And that way they can get some European pension fund money to invest in them, for example. What does this mean and what's my concern? I'm very supportive of the theory, but I'm concerned that too much money is going to flow towards too few companies, and a ESG company is going to trade at too high a premium to a non-ESG company. So we need to balance and see exactly how this is going to pan out. I do fear that in the short term, we're going to see sort of irrational exuberance towards ESG companies, and we need to be careful in the ESG portfolios that we're running that we don't get too caught up in that exuberance. Okay, Brexit. It's actually boring to talk about Brexit because it's been going on for so long, and it's very difficult to know. We do have a deadline around the corner. The transition period formally ends on 31 December 2020. They're supposed to have a solution. They're supposed to have negotiated a trade deal. Maybe if there wasn't Corona, they could have possibly worked through all the details of a trade deal, but it's enormously complex negotiation. Certain industries like financial services have their criteria, other industries have their criteria, enormously complicated negotiation. And I say that I believe a full trade deal by next Thursday is highly unlikely, okay? So either we're going to have a no trade deal where the Europeans tell Boris, that's it, you're out, or they agree to buy time, which I think will be the most likely result. But we will only know until about 5 minutes before midnight on the 31st of December. So they're really going to take us to the end. I believe that there will be an extension of some sort. If for whatever reason, Boris Johnson digs his heels in and the Europeans dig their heels in and they announce no deal, I think that we'll feel that more through sudden weakening of the sterling rather than the FTSE or the European stock markets, which we felt when Brexit first happened in 2016. So that puts a dilemma for our British clients living in Israel, sitting on sterling. It's a real challenge to decide what to do there. But my base case is further delays, and Brexit is just going to hang in the air. First deal with Corona, and then we'll deal with Brexit, perhaps. Inflation. Okay, so this is often talked about story, and as I said, the size of government intervention following Corona is absolutely enormous. It's more like World War II than 2008. So we have enormous amounts of government intervention, money creation, debt creation. And there's no way to repay that or strengthen the balance sheets of the governments through growth and taxes. You can't possibly tax your population to the extent that's required to bring those balance sheets under control. So the only way out is to allow inflation, okay? The Fed has already said that when inflation goes above 2%, they're going to let it run and to 3%. But that doesn't mean we should expect 1970 style 7, 8, 9, 10% inflation. I don't believe we're going to see that type of inflation. If we see inflation between 1 and 3, it really should not change your investment strategy that much. We've already been experiencing asset inflation since 2008. Asset inflation, which equities, property, other types of assets go up in value because there's more money, more rich people, the rich are getting richer. And your traditional measure of inflation being gross domestic product inflation is not reflective of what's happening around us. When it comes to protecting your portfolio from inflation, there's a few ways that people talk about, okay? Gold is one way, it's the traditional way. In my opinion, this is antiquated. This is thinking from the 1970s. I don't believe that gold is a fundamental way to protect your portfolio from inflation. It's too volatile. How can you possibly hedge a portfolio with something that lost 50% of its value between 2011 and 2018? Gold went from 900 to 1800 dollars an ounce and then back down to 900. Something that volatile cannot be used as a hedge by definition. You want something that will protect you, not that will be as volatile. So I'm not a big believer in gold. It's also very difficult to predict who will be the buyers of gold. And while you hold gold, you don't get a coupon or an interest or dividend or anything like that. So I'm really not a big believer in gold. We do get some kind requests to buy gold, but I'm not a huge believer. Bitcoin, I'm going to show you in a second why I don't believe Bitcoin. I don't believe Bitcoin to be a currency. The proponents of Bitcoin will try to convince you that Bitcoin is the new currency because all the banks are bankrupt. I don't get that. I think it's too volatile. It's even more volatile than gold. And it cannot, if it's volatile, it cannot be used as a store of value. And therefore, the hedge argument doesn't work for me for Bitcoin either. Another thing with Bitcoin is the criminal association. Just recently in Israel, we had a financial services company that was blackmailed for data that was stolen, and they wanted Bitcoin. So the more this happens, the more criminals are using Bitcoin, the less mainstream it's going to be, and the less likely it's going to be mainstream, and therefore it'll continue to be volatile, and therefore you can't use it as a hedge. So TIPS is another, that's inflation-linked government bonds, otherwise known as TIPS. TIPS are linked to, in my opinion, the wrong inflation metrics, and they don't properly protect you from inflation. Now, if you buy a TIPS ETF, the price of that TIPS is going to react more to expected inflation rather than actual inflation. So you buy something which arguably is supposed to protect you, but it's actually reacting on a forward-looking basis. So I don't love TIPS that much as a tool, and they also provide almost no yield while you are holding. So what can you do? So I believe that traditional equities, diversified portfolio of equities, will have an inflation-driven component to that future growth. We have a fundamental assumption with equity investing that we expect between 6 and 8% from our equity exposure. How do we get that 6 and 8%? 2.5% growth, 2% inflation, and 2.5% dividend, roughly. That's how we get our expectation of returns on an equity exposure. So it's already included in that exposure. And I believe a traditional portfolio, an asset allocation-based portfolio, will do a pretty decent job in protecting your portfolio against inflation. If you tilt your portfolio towards the traditionals, which is gold and TIPS, and the modern Bitcoin, if you tilt your portfolio to that, you're going to introduce too much volatility, too much unpredictability in your portfolio, and therefore your portfolio will just become unpredictable. So I think that traditional asset allocation, perhaps a little bit more equities than you otherwise would be comfortable with, is a fair enough way to protect your portfolio from inflation. Just to illustrate the volatility point versus the currency, this is a graph which is for my South African friends. The green line is the South African rand, and the red line is Bitcoin. And because of the scale of Bitcoin's volatility, it actually looks relatively flat. Now, if the South African rand dollar looks relatively flat compared to a Bitcoin, you would never use the South African rand to hedge your portfolio for anything, right? And therefore, why would you use something as volatile as Bitcoin to protect your portfolio? Okay, now talking about the stock market in general, clients ask me, oh, the stock market is too high. they feel that the corona damage is much greater than we think, and therefore they anticipate some sort of crash. By the way, there's always somebody who thinks the stock market's going to crash. It doesn't matter what. I've been in this game 20 years. There's always someone who says the stock market's going to crash. The stock market's been going up beautifully for the last 20 years. So we shouldn't take too much cognizance of the naysayer. The key sign of a bubble is irrational behavior. And the classic example is the 2000 dot-com bubble. We saw completely irrational behavior. We saw brand new companies trading at insane valuations, and that was irrational behavior, okay? In today's world, we see very high valuations of some companies, but there's a very strong business there, and there's a strong rationale behind that high valuation. So it's not totally irrational behavior. More importantly, in my opinion, equities are still cheap relative to bonds. Okay, so if the bond market is so high and interest rates are so low, that means there's a lot of money that needs to be put into the market to get returns. Imagine a pension fund somewhere who's reallocating money from bonds to equities. That's just going to create an enormous demand for equities. And as long as interest rates stay low, equities will get strong support. So in my opinion, equities are not a bubble in general. I do have some serious concern about some of the new IPOs that have been listing on. We don't necessarily buy them. In general, we don't buy them. And again, and to mention Tesla, Tesla is a topic of conversation. Tesla has just entered the S&P index. So we're sort of top-down asset allocation company. We have the S&P. Now Tesla is in the S&P, roughly 2% of the S&P. Funny enough, it entered the index in number 7. So the S&P is made up of 500 companies ranked in size, the biggest to the smallest. And Tesla entered the index at number 7, which is amazing. Okay, it just shows the size of that company. And that's what concerns me. If you look at the pricing of Tesla, it's trading at 1,000 PE of its historic earnings and 300 times earnings of its latest earnings. Now, that was an enormous valuation. The people who are in favor of Tesla will argue that there's exponential growth coming, not just high growth, but exponential growth. Now, if you buy that argument, then you expect that in 5 or 10 years' time, 1 in 5 cars on the road will be Teslas or something is significant like that. But at least it's not irrational. There's a logical reason why Tesla is trading so high. It's a unique company with unique leadership, and people believe that it's going to fundamentally change the automotive industry, and that's why it's trading at such a high multiple. Whether it is or isn't, I'm not going to debate, but the point is that I don't think it's entirely irrational on that subject. Okay. The challenge for the average investor, particularly the average pioneer investor, who I would say is a preservation plus mentality, they prefer not to lose than make huge returns. That's our average customer. We use bonds. Historically, we've used bonds. Bonds are more predictable, less volatile, and they're an important part of portfolio construction. However, because of Corona, because of the monetary policy expansion, because of low interest rates, bonds are very, very expensive. And that means the conservative bonds that we would otherwise have bought in the portfolio are giving very low returns. And now the challenge for the investor is, do I take on additional risk or different types of risk to get back to the returns that I would regard as interesting? The client, okay? And so we need different risks. So for example, we've been a big promoter of structured notes. And I still believe structured notes are a very important part of this problem. And structured notes give us a different risk return profile. They're not stocks, they're not bonds, there's something in between. At least we get a more interesting return. We're also started allocating money to Asian bonds, which they're okay companies, geographically higher risk. But again, that's a different risk return profile that we're looking for to replace traditional low yielding bonds. Just to graphically show this to you, I don't want to go into too much detail. We've got the blue here is 2007 interest rate level on bonds. The turquoise is 2012, and the green on the right is 2020, September 2020. Hasn't changed much since then. And the left-hand side of the graph is more conservative bonds. The right-hand side of the graph is more aggressive bonds. This area here, as you can see my mouse, the investment grade 1 to 5, this was the bread and butter of your average investor in the past. And you can see that we got a nice comfortable 5.5% in 2007. 2012, that went down to 1.6, and now we're at 1.1. So you can just see how significant over the long term this lower interest rate environment is. And I think that that's going to be a big challenge going forward for investors. Okay, concluding remarks before we jump onto questions. Overall, we're supportive of risky assets. We think, including in Israel, we think that the post-corona world is in sight, and we feel that the corona risks are under control. Economic activity in 2021 is going to be very strong, all right? Whether it's out of the US or in Israel, there's a tremendous amount of fiscal expansion that's coming out of the US and some post-corona reawakening. So I think that economic activity will be strong. This will provide a tailwind to risk assets in 2020. Obviously, bad things could happen, but at least the macro picture is we are supportive of risk assets. Equities have good value relative to bonds. One shouldn't fear a bubble in equities, in my opinion. A key risk, I mentioned it before, is the vaccine rollout and virus mutations, which has been in the news the last few days. If the vaccine is ineffective or has side effects, or if there's virus mutations or continued, or the rollout of the vaccines takes too long, then we could see a negative impact in the market. With respect to inflation, I expect small increase in inflation, nothing major, nothing like 1970s, certainly nothing that you should panic and buy gold, which would have been a traditional thing to do 30 years ago. So that's inflation. With respect to the US dollar, I think that we're reaching that overshooting stage. And I think that most of the USD weakness currently is priced in. For Israel, I believe that there's still a longer term challenge, and that the shekel will strengthen over time, driven by those gas exports that I mentioned. Low rates are going to be a real challenge for investors, and we have to come up with different ways to deal with that. I encourage structured notes. The clients on this call have probably had discussions about structured notes with their advisors, and I support that. ESG solutions are available in Pioneer. We do run ESG portfolios, which are environmentally sensitive, etc. And if anyone is interested in that, they should just speak to their relationship manager. Again, we're not merging our traditional investment approach with the ESG approach. We're running the two parallel for now. We'll see when we have more confidence in the ESG approach, then we will perhaps merge the two. But right now, most clients are in the traditional approach unless they request otherwise. Okay, thank you for your time. I'm going to open up for questions now. Okay, the first question is, with an overvaluation in Tesla at 1%, is it worth taking profits in the S&P? This is very, taking profits in the S&P is very short term and very tactical. So what are you going to do with the money afterwards? Okay, what do you need to look at your S&P weighting in your portfolio and see if that weighting is a comfortable place. I always am amazed when I see people who are otherwise sophisticated investors, experienced investors, who come to me with their portfolio, and I don't see any traditional plain vanilla S&P 500 ETF. In my opinion, every portfolio needs that line item, whether it's for 10%, 20%, 30%, it needs that line item. And so if you sell the S&P and take profits, you need to have a plan what you're going to buy. Okay. And again, there's a lot of proponents of Tesla to say Tesla Tesla's growth is sustainable. I'm a bit skeptical, but I'm not an expert on Tesla. Next question. What happened? Can't the income from the gas used to be paid for the government stimulus policy and not cause the Dutch disease? If not, why not? Well, the gas fields are there are special taxes on the gas fields, and the government will benefit. So not fully, but it will benefit. They're going to tax those gas fields differently to normal companies. This is a huge debate in Israel as to who paid for the exploration, who paid for who took the risk on taking the gas out the ground, etc., etc. But I believe there are higher taxes, and the government will benefit to some extent from the gas exports. Sorry, the next question is, can we explain why stocks will be a better investment under inflationary environment? Well, what are your alternatives? Okay, so everything's about alternatives. If inflation comes, right, what can you invest in? Cash is a bad idea. Traditional bonds are a bad idea. Tips, I explained, are not fully effective. Gold, too volatile. Bitcoin, not trustworthy, too volatile. What will you invest in? Historically, if you look at countries like South Africa, there's a lot of South Africans on this call. Equities have a strong long-term inflation component in them. The South African stock market over many, many years has, if you strip out inflation, it's not an attractive market at all. If you include inflation in rands, it looks okay. So there's something about equities that, because it's more of a short-term asset compared to bonds, there's an inflation component in the equity value, in the equity valuation. And I think that a traditional portfolio should cover the low levels of inflation which are expected, right? So right now, inflation is super low. It might tick up, but it's not going to be at as 8, 9, and 10%, in my opinion. So we don't need to throw the baby out with the bathwater and re-strategize everything. I just think perhaps a little bit more equities in a traditional portfolio than you otherwise would have will be enough to protect you for low levels of inflation. Next question. Given the lag in returns in 2020 from Israeli stocks, given your expected robust economic activity, does that imply there's more upside in Israeli equities versus global? Wow. Tough question to answer, but I would say that I would say probably yes. I mean, I wouldn't direct money from dollars to shekels because of this point, but I do think the Israeli market and the European market are lagging the US market, and this was heavily driven by technology companies. So yes, I do think that there's some upside in Israeli risky assets, which includes the corporate bonds, and we are there. But switching the one to the other, that's a more detailed discussion. But I do think that the environment is supportive of risky assets, including Israeli stocks. Please briefly explain structured notes. We've got a whole webinar on this. If you go to the Pioneer YouTube page, there's a whole webinar on structured notes. Largely speaking, it's a hybrid. It's not a bond. It's not a stock. You get many, many different types of structured notes. We like index-linked structured notes, and you give away your upside beyond a certain number, and you get some downside protection. So, for example, if the S&P goes up 20% and your structured note gives you only 10, you've given away that upside beyond 10, and you've bought, say, 40% downside protection. So you won't lose money if the underlying index doesn't fall more than 40%. So you've got protection and you've given away some upside. Basically, it's a hybrid, and I think it's a good place to get an interesting return, whereas traditional bonds are not giving any thing. There's a question here about cannabis as an asset class. I think it needs more time. it's tremendously volatile. Anyone who invests in cannabis and has seen the ups and downs of, I think it's in its infancy as an industry. It's beyond a tipping point, right? So it's here to stay. The cannabis industry is not a fad. It's here to stay. But I think it needs a bit more time before it becomes a traditional asset class. Maybe in time it'll become a traditional asset class, but right now it's just too volatile to predict, and therefore it will fall out of our asset allocation methodology. There's a specific question about ARM and Intel. I'm going to pass on that question and answer offline. Corporate stock buybacks and the impact on the market. Corporate stock buybacks have been a big part of US stock growth over the last 10 years, so it's a significant factor. Will it continue or will it not continue? I think it'll continue, but to a lesser extent. It's difficult. It's one of those things that are difficult to say with certainty what will be the consequence. Okay, there's another question about how I feel about the Bitcoin. Basically, I'm a Bitcoin skeptic. If anyone wants to buy it, they can buy it, but I don't know what. It's definitely not a currency. It's an electronic commodity. If someone says that it's limited in number and therefore its value comes from scarcity, then I'm skeptical, because who says? You need a PhD in mathematics to understand the Bitcoin formula. And just because everyone says Bitcoin is limited, who stands behind Bitcoin to say Bitcoin is limited in number? I don't know who that someone is. As the more Bitcoin is used by criminal organizations for ransom money, the less credibility it's going to have. So right now, Bitcoin is not something I would consider investing in, especially now at $23,000 thing. It's funny that Bitcoin only comes back into conversation when it's high. No one talked about Bitcoin for many, many years. Suddenly it hit 18,000 and people were talking about Bitcoin. Then it went down to 2,000. Nobody was talking about Bitcoin anymore because they'd lost 80% of their money, those who bought it. Now it's back up at 22,000. I think, it might fall again, but I don't know what drives those returns. My geographic preference for equity allocation. We are if you look at the MSCI World Index, is the whole world of stocks. It's about 55% USA, and it doesn't have a lot of China in. There's a plan to increase China in the MSCI. We are overweight USA and overweight China, underweight everything else. We are underweight Europe. We're a bit skeptical about Europe's ability to grow meaningfully. We're underweight all the other emerging market countries, Brazil, India, Russia, South Africa, those type of countries. We're a bit skeptical about. I think China's dominance, if we take a long-term view, China's dominance is going to be difficult to refute. If we look at China in 10 years' time versus today, there's a good chance it's going to be a hell of a lot bigger. And therefore, we think China belongs in a long-term growth portfolio. The US, we still, it's the strongest economy in the world. We still think that it belongs. And we will probably not be selling down and taking profits on the holdings that we have. And last question. Bitcoin is not supply limited because it can be subdivided in. I agree. If it's infinitesimally divisible, then it's not limited in size. I fully agree with that, and I concur. Okay, there's a couple of. Okay, I think I've addressed all the questions. Thank you all for the time. If you want to rewatch any part of this, the link will be on our YouTube channel. Please don't hesitate to raise any issue that was discussed here with your relationship manager, and we're at your disposal. Thank you very much for the time.